Hey everyone, it's evident that the US economy is facing some serious challenges, and the ripple effect is shaking up global currencies. This all traces back to the Federal Reserve's decision to keep interest rates high, driven by the persistent issue of inflation. It feels like we're glimpsing the beginning of the endgame, where traditional tools like deficit spending no longer seem to make a dent, and we're stuck in the grip of stagflation. In March, core inflation in the US surged once again, hitting a concerning 0.3%. Spending is on the rise too, reaching a solid 0.5%. US households are shelling out more than expected, painting a picture of a thriving economy on the surface. But beneath the surface, the Fed is grappling with a troublesome reality. The crux of the issue lies in the stubbornly high interest rates, with the Fed funds rate stubbornly sitting at 5.5%, wreaking havoc on the global economic landscape. Now toss in the mix of relentless government spending from the Biden administration, and you've got a recipe for disaster. There's a looming threat of a hot landing, catching us off guard. Market expectations hint that the first rate cut might not come until December, a good 6 months away. And even then, the reduction might be modest, perhaps just 33 basis points. If things continue at this pace, we could easily see interest rates climbing above 5% by the end of 2024. This situation brings a host of complications, particularly as the US government finds itself continually in need of borrowing. Biden's hands are tied, compelled to keep the financial engine running until November. For the April to June quarter alone, the US Treasury is set to borrow over $200 billion in debt. And let's not overlook the additional $95 billion allocated for Ukraine, Israel, and Taiwan, bringing the total borrowing to a staggering $300 billion. All this new money will need to be conjured into existence through borrowing. This relentless issuance of debt presents a dilemma for Janet Yellen. With rates stubbornly high, the more she borrows, the deeper the hole she's digging for everyone. Balancing the issuance between longer-term bonds and short-term T-bills used to work, but the strategy is shifting towards favoring more short-term debt due to its quicker maturity. The expectation was that cutting rates would alleviate some of the pressure, but that's not panning out as hoped. The Federal Reserve can't afford to make any rate cuts anytime soon. Treasury yields are soaring across the board. 2-year bonds are at 5%, 30-year at 4.8%, and 10-year above 4.7%. Regardless of the type of bond the Treasury issues, they're in a bind. More capital is flowing out of the real economy, seeking refuge in Treasury bonds, exacerbating the global currency crisis. These higher rates are squeezing US companies and pushing the US debt crisis to unprecedented levels. You might assume that deficit spending would be a boon for the US economy, borrowing more money today to fuel GDP growth tomorrow. However, as we've emphasized time and again, the borrowed funds aren't being put to productive use. Instead of fostering real economic growth, they're funneled into endless wars and the military-industrial complex. When you borrow $1, you'd expect to see a return of at least $1 or more. But that's not the case here. The Congressional Budget Office projects the US deficit to swell to $1.5 trillion this year, with this massive sum borrowed from global investors to shore up the economy. This deficit amounts to a hefty 5.3% of GDP. Last year, in 2023, deficit spending hovered around 6.3% of GDP. Logically, you'd anticipate GDP growth to mirror the rise in deficit spending, or at least come close. However, this year's economic performance has been disappointing. The US economy is sluggish, while inflation is on the rise, throwing a wet blanket on hopes for a soft landing. GDP growth for Q1 clocked in at a meager 1.6%. Falling short of economists' expectations of 2.5%. This downward trend in economic growth is alarming. Since Q3 of last year, GDP has been steadily declining, from nearly 5% to a mere 1.6%. Such a sharp downturn signals trouble ahead, especially as Biden continues to borrow astronomical sums to prop things up. So, why is this happening? It boils down to ineffective spending. The money isn't being used in ways that foster genuine growth and progress. In the realm of economics, where it truly counts, a substantial portion of funds is allocated towards servicing interest payments on existing debt. The interest on the national debt skyrocketed to $1 trillion in 2023. And this figure is only set to balloon further as the Fed remains steadfast in its reluctance to slash rates. Herein lies the quandary of perpetual deficit spending at elevated interest rates. The borrowed funds are predominantly channeled into servicing existing loans, devouring capital, and stifling growth in the real economy. This critical issue is often overlooked in discussions. Yes, Biden may continue to ramp up borrowing, but that doesn't automatically translate into corresponding GDP growth. The efficacy of this stimulus is already waning. Higher rates aren't just impacting the national GDP, they're beginning to exert a crushing burden on households as well. We're witnessing a significant reversal in consumer spending patterns, particularly among lower and middle income groups. Household net interest income has plummeted during this rate hiking cycle, confirming our worst fears. The rising cost of debt is outpacing any increase in interest income from higher bond yields. If rates surged from 0% to 5.5%, one would expect individuals to reap greater returns from their bond holdings. So why has their income dwindled from $900 billion to $670 billion? The answer lies in the fact that people's liabilities have expanded even further. Mortgages are ballooning, and credit card debt is soaring to unprecedented heights. This is the double whammy of stagflation. Rising prices compel households to spend more, prompting them to rely increasingly on credit cards, ensnaring them in a perpetual cycle of debt. The longer this cycle persists, the more it imperils consumer spending. And all of this can be traced back to the profligate spending habits of Congress. You'd think that economists like Janet Yellen would grasp this concept, right? She ought to be advising the US government to rein in deficit spending. But instead, she seems to be residing in a fantasy world, operating in what feels like the Twilight Zone. According to her, the US can rein in inflation without sacrificing jobs, but I beg to differ. With Congress spending at its current rate, the longer this continues, the longer interest rates will remain elevated in the US. And this will inevitably impact both company investments and consumer spending, creating a domino effect that will eventually reverberate back onto American jobs. Even the IMF is wagging its finger at Congress over this issue. The IMF warns that the US deficit poses a significant risk to the global economy. To be fair, the IMF has also reprimanded the UK, China, and Italy, but the US holds a disproportionate sway over the world economy. By 2025, the IMF projects the US deficit to swell to 7% of GDP. Now, you might wonder why the IMF is singling out the US when countries like China and India are borrowing even more. Well, for starters, China and India boast much higher GDP growth rates than the US. Additionally, a significant portion of their debt is held domestically, whereas US debt is predominantly held globally. But most crucially, these two countries don't possess the world's reserve currency, unlike the US, which wields the mighty dollar, akin to the One Ring. The IMF contends that Congress's spending spree has driven core inflation up by 0.5%, thereby prolonging the period of elevated interest rates. This isn't just a concern for the US, it's a full-blown crisis for the global economy. Why? Because the dollar reigns supreme as the reserve currency, with everything pegged to it. So when the dollar strengthens, imports become pricier for countries outside the US. Moreover, when the Fed keeps rates high, it siphons capital away from the rest of the world into US bonds. Investors realize they can earn over 5% on US bonds, and the allure is irresistible. As a result, they devalue their local currencies to acquire dollars for investment in treasuries, driving the dollar even higher and causing currencies worldwide to plummet. It sets off a chain reaction that not only exacerbates inflation, but also threatens global economic growth. The crux of the issue lies in the elevated interest rates in the US. A mere 1% increase in US rates translates to a 90 basis point surge in advanced economies, and a 1% rise for emerging markets. Everyone bears the brunt when the US maintains higher rates, as we're witnessing today. Take the Japanese yen, for instance. With yields in the US surpassing 5%, while in Japan they linger below 1%, capital flees the yen. The sell-off is relentless, with the currency weakening beyond previous intervention levels, now standing at 158 yen to the dollar. Consequently, imports to Japan become pricier, burdening consumers. Japan serves as a poignant example of a nation forced to watch its currency depreciate due to its own debt crisis. Unable to counter the Fed's actions by raising rates, their sole recourse is to witness the yen's devaluation, an illustration of a global phenomenon. Currencies and economies worldwide are taking a beating, prompting the IMF to issue a warning. America's deficit spending is not just harming other nations, the repercussions are far from over. The issue extends far beyond just a dip in GDP or soaring inflation. It's now shaking the very foundations of US banks. Today we're grappling with a fresh bank failure as regulators step in to take control of Republic First Bank. This marks the first US bank crash of 2024, illustrating how higher interest rates are wreaking havoc on balance sheets. Let's delve into the grim reality. Their total equity plummeted to $96 million, but with $260 million in mark-to-market losses on bonds, the bank finds itself insolvent. It's effectively underwater, with a negative worth. While Republic First Bank isn't a banking giant like SVB, with total assets around $6 billion, its downfall underscores how prolonged high rates are eroding banks' assets, potentially driving them to insolvency. When yields rise, everything from treasury bonds to real estate loans takes a hit in value, and if the decline is significant enough, it spells doom for the bank. The silver lining? Depositors haven't lost a penny this time, but there's no guarantee of such luck in future bank collapses. Depositors could suffer losses, underscoring the importance of considering gold as a hedge. The scale of the problem is staggering. US banks are grappling with unrealized losses, totaling $600 billion in rates, a ticking time bomb waiting to detonate as long as the Fed remains obstinate. What's truly alarming are the paper losses on held-to-maturity (HTM) bonds. Though banks intend to hold these bonds until maturity, a severe crisis could force them to sell, triggering a massive repricing. For some banks, these losses could surpass their entire asset base, leading to bankruptcy. If depositors flee or other segments of their portfolio collapse, like commercial real estate, the fallout would be catastrophic. Until the Fed acknowledges and addresses systemic risks, the US banking sector remains on the brink. Last year's banking collapse surpassed $500 billion, an amount exceeding the failures of the 2008 crisis, underscoring the severity of the situation. And with inflation constraining the Fed's ability to cut rates, the outlook is bleak. Even if rate cuts materialize, they may come too late to salvage the system. We're navigating treacherous waters, and until decisive action is taken, the specter of systemic collapse looms large. We're facing a dire predicament. US deficit spending has lost its efficacy, yet inflation remains stubbornly high. To avert catastrophe, borrowing must persist, leading us perilously closer to stagflation. Economist simulations on US government debt paint a grim picture. A staggering 88% show the debt-to-GDP ratio hurtling down an unsustainable trajectory. Eventually, we'll confront a tipping point. Either the US government becomes unable to meet its debt obligations, or it resorts to printing money, thereby devaluing the dollar. As Biden continues his borrowing spree at elevated rates, we edge dangerously closer to the precipice. By 2050, the interest expense on the debt alone could devour a whopping 6% of GDP, the equivalent of 6% of the entire US economy. Such a scenario is inherently unsustainable. This isn't fear-mongering, it's an undeniable outcome rooted in mathematical reality. To salvage the US economy, and by extension, the global economy, we must halt the relentless spending. The first step? Cease the two ongoing wars that drain our financial resources. The cycle of endless borrowing must be broken. But let's delve deeper. Is the IMF correct in sounding the alarm on the US deficit crisis? Are more banks teetering on the brink of collapse? Share your thoughts in the comments below. Stay vigilant, stay safe, and remember to hit the like button and subscribe as we navigate these turbulent times together.